He is now the chair of Deloitte, Canada, where he has led the transformation of its mining practice into one of this country's largest professional service groups dedicated to the sector. Born in England, he attended the University of Waterloo in Ontario and became Ontario's UFE gold medalist. Mr. Ives' topic today is entitled Tracking the Trends 2013, Deloitte's 5th annual report on the top 10 issues facing the mining industry. Please welcome today Mr. Glenn Ives.
Good morning. Thanks very much for the invitation to speak today. I'm not going to have any slides, so I'm just going to talk a little bit about what we're seeing and hopefully give you a little bit of a feeling for what we're seeing around the world in the mining industry, and particularly as it affects some of the junior mining sector. Tracking the Trends is a publication we put out. We drive it from interviewing the partners who work in the mining industry for us around the world. So there's 50 partners that we interviewed. If we don't audit the mining companies, we provide advice, and we deal with small right up to the mega companies. You know, the thing about mining is it's actually cool to be a miner again, and it's taken us a long while to get there. You know, there were 20 years in the 80s and the 90s where nobody joined the mining industry. When you look around the booths out there, you have some young people and you have some not quite so young, maybe more experienced is the way to put it, but there's a real gap in the middle. You know, there were other things to go and join in those years. If you think about it, high tech was hot, financial institutions, investment banks, all those things that perhaps have fallen a little out of flavor lately. The other thing is, to be in the mining industry now is to be in the news every day. Sometimes it's not good news, but at least it's news, and that's certainly better than the alternative. If you read the newspapers, you'll kind of get the feel that commodity markets are bad, equity markets are bad, everything's bad. You know, is it that bad? I looked at some of the commodity prices, and iron ore. So iron ore has slowed down a lot because of the Chinese economic slowdown. In 2002, it was $12 a ton. In 2009, it was $100 a ton. Yes, in 2011, it got up to 187. We're now back at, you know, in the 110, 120 range, maybe trading above that, below that. But there is a significant difference in where it was in 2002 and now. Like, that's a 10 times difference. And we don't see that changing. Copper, you know, I grew up in the mining industry when I joined the mining industry in '88. For the next 15 years, we dreamed about copper north of $1. Now, I'm not sure I can see copper less than $3. Right now, it's solidly in the mid $3 range. These are significant changes, and there's a bunch of reasons for them, and I'm going to talk to them. You know, if I look at gold and silver, the previous speaker talked a lot about why gold and silver are worth more than they used to be. I'm not going to get into that whole investor demand and currency issue, but I see no reason that gold and silver are going to go down significantly in the short term. There are just no supply-demand reasons why that's going to happen. The equity markets, we are seeing some deals get done now. So they're not as bad as they were. However, they're still not healthy. I think we're waiting for a return of confidence really to the US consumer. And I'll talk a little bit about that, where I see that going. So to discuss mining trends, one has to have a bit of a view of what's happening around the world. So if I look at Europe, Europe is going to go from crisis to crisis to crisis. It will not go to catastrophe. And the reason is, every time it gets close to catastrophe, Angela Merkel can go to the German people and say, we've got to bail out this person or this bank or this country or whatever. The other side of that is, if you're running Greece or Italy or Spain, when you get to the catastrophe stage, you can say to your people, I have to sign this deal with Germany and the IMF, et cetera, just to avoid going to catastrophe. And so the problem is, it's not going to there's going to be no solution in Europe, in my view. It's going to just be a continual series of crises. The world is getting used to that. We've been living with crises in Europe for the last 3-4 years. Every one kind of worse than the next, but every one solved at the last moment. So I think that's going to continue. I look at the U.S. I talked about the U.S. retail investor. The U.S. retail investor, to me, is the key to junior mining. They're the ones who come in and provide a lot of that risk capital that goes out and funds the exploration efforts around the world of primarily Canadian companies. That consumer or retail investor has taken a huge hit over the last 5-6 years. However, we are seeing signs of change. I was up in Prince George last week talking to lumber producers. They're now running their sawmills at 100%, first time in 5 years. Interestingly, though, they're not just selling to the U.S. One of the interesting things that is happening as a global trend, the U.S. is no longer setting prices, whether they be copper prices, lumber prices, or even food prices. Those prices are being set in Asia. So those lumber producers, one of them I was talking to, he used to ship 70% of his mill output, and it's the largest mill in BC, to the U.S. He now is probably never going to ship more than 35%. A big chunk of the balance goes to Asia. Huge China markets are booming. So we're seeing housing starts in the U.S. pick up. We're now back to 800 to 900,000. That's down from 1.2 million, which is sort of replacement, but far better than the 600,000 that we've been seeing for a long while. So my sense, U.S. economy stronger than you will ever read about or listen to on CNN or Fox or any of those other places. And that is actually going to fuel more money into this sector in the medium term, short to medium term. If you go to Asia, China's not going anywhere. Yes, they have problems. They have severe structural problems. They have a massive demographic issue, but they have huge demand. And they have created a middle class that's going to continue to demand things. And if the Communist Party wants to stay in power, they have to give the people of China economic hope, economic development. I was talking to a food importer, a food distributor, sells food around the world, hundreds and hundreds of millions of dollars of food. He is now shipping direct from South America to China because he can make more profit by selling blueberries, raspberries, grapes, and that, by selling into China. One of his comments was, in North America, we've got used to all having everything at the lowest prices. We're going to run into scarcity, and we'll have to compete for those dollars, for those goods. However, from my perspective, the important thing is it's that middle class in China that is driving that. Now, as I look at it, will mining companies, will exploration companies make the right decisions today for the future? Or are we just going to perpetuate this boom and bust that we've seen in the mining industry for so long? So let me get into our trends. The first two trends are, I would say, the mega trends of the industry, cost and price. So if I take cost first, you know, actually an endangered species right now is CEOs of major mining companies. They're turning over at a rapid rate, primarily because costs are out of control. Capital costs, operating costs, doesn't matter. There's some other things hidden within the numbers that are important and also very relevant to future commodity prices. One of the things we look at is the average grade mined. You know, for those of you who know mining, I know this is obvious, but it doesn't actually matter how much mineral is in a ton of rock. It's interesting, but what your cost is how many tons you have to move. We have not had the big discoveries. We are drawing down on discoveries that were made in the past 40, 50 years. And that average grade is dropping continually. Now, some of that's in relation to the fact that the price has gone up, so you can mine lower grades. But if you look at the big copper mines, And copper is the engine of the world. As copper goes, the economy goes, or as the economy goes, copper goes. I guess is probably a better way to put it. The big copper mines that we're living off were all discovered in the 60s and 70s. You think of the Chilean copper mines, massive new discoveries back then that have been in production ever since. And you go around the world, the same. The new discoveries that we are making, it's really, really hard to get into production. So they're not helping on the supply side. It's just, it's you know, a sort of a perpetual problem. The lifetime, the life cycle of a mine used to be 5-6 years from discovery to actually getting production. It's now north of 15 years in many, many cases. If I flip and look at pricing, we've got volatility. And whenever you actually are at a place where supply and demand are roughly in balance, you get a lot of volatility because a small move in either side of that equation makes a bigger move in price. One of the things I love about mining is miners are optimists. If you're an explorer, you believe your property has that deposit on it that's going to make you rich and going to be a new mine. If you're an operator, you never expect your mine to have trouble. So the last few years, if you add up all of the forecasts of what production is going to be in copper, and you look at what demand is expected to be, the world has been in surplus copper every year. But what happens is every mine has problems. You know, they have strikes, they have operational issues, they have governmental, environmental issues. Continually, year after year, we undersupply the market. So we've actually been in deficit in copper the last few years. What's been keeping the market balanced has actually been the stockpiles of copper in China. Huge stockpiles. The Chinese are incredibly disciplined buyers. I've seen it in copper. They are buyers at, say, 340 when the price is trading between 340 and 350. And at 341, they're out of the market. Forget it. Iron ore, the same. I was surprised when I was in Prince George to hear with lumber, they were talking about exactly the same thing. You know, at 322, they have unlimited demand from China. At 325, they have zero demand from China. And that moves up and down, but they're buying on weakness in any commodity. So you've got, the trends, the first two, remember, are the mega trends, cost and price. If I get to the next two trends, they're sort of impacts of the first two. The first one is capital project deceleration. There just aren't as many capital projects going forward now, and the ones that are going slower. Now, partly that is a rational response. If you're a CEO of a big company and you've just seen 5 of your friends lose their jobs, you're going to kind of be cautious about what you're going to do next. And so we're seeing some of that. Some of it's from capital. The capital just isn't there to build projects. In fact, the only place that I'm seeing capital, significant capital coming out to finance new projects is really out of Asia. Not just China, Korea, Japan. So there's a lot of capital coming that way. Big mining companies are able to use their other producing properties to finance projects. However, if you're developing a new project, very difficult to do that. You really are looking at joint ventures or some form of arrangement with an Asian company. And, you know, the deal is that they want the offtake. And the great thing about Canadian miners are they are totally agnostic as to where their offtake goes, as long as they get world prices and they get competitive treatment and refining charges. As long as they get those things, they're happy to give away the long-term input. Now, why is that important? Think if you're Samsung. If you're Samsung, the value of the rare minerals that goes into your cell phone or tablet that you're making is about that much. And the value you create from that is that much. So you actually are not sensitive to price at all. But If you don't have those rare metals or other minerals, you cannot make a thing. You are out of business. And so there's a lot more securing long-term supply. That's what China's doing. You know, think of that Samsung example in terms of an entire economy built on commodity need, commodity demand. They're making sure they've got the commodities that then allow them to grow the rest of their economic base. The second impact is mergers and acquisitions. And that's very relevant for the junior mining space, the junior exploration companies, because the senior companies have shown themselves to be totally unable to find new discoveries. It is the rarity for a major company to actually make a discovery. Almost all the discoveries will be made by companies like the companies that are here today at this show. They will be bought out. You just heard the last speaker talk about the recommendation. I think it was Canadian Zinc. You know, they found the deposit. They're going through the basic permitting. They'll get the permit. Then somebody will come and buy them. That will be a major company. We see more M&A because we think people are going to be replenishing lines. So bigger companies are going to be replenishing their mine lifeline. They've got production shortages coming in the future. They won't be able to continue to produce at the levels they need to produce, partly because their grades are going down, their mines are getting older, they need new production. So that's very positive for this space. I think if you think about it longer term, it means that there's a need for new discoveries. People will start to see that and start to invest in this sector, which of course means higher share prices. There's also a lot of consolidation going on at the larger size of companies, and you'll see that transferring down into some of the exploration companies. You'll have companies that have cash, companies that have better prospects joining together. At the largest scale, you're seeing the takeover battle between Inmet and First Quantum. You're seeing Horizon and Alamos, a number of these combinations. They're going to continue. There's a lot of activity. There's also a lot of activity out of China. I think, you know, in the oil and gas sector, you've kind of seen a bit with Nexan and Sinopec and people like that, CNOC. Again, there's going to be more activity out of Asia. Korea as well. Don't underestimate the amount of stuff Korea is doing. They're quiet, very good partners if they come in. Again, they are looking to lock up the offtake. So those are our top four trends. So the first two, the mega trends, cost and price. The second two, capital projects slowing down, which if you think about it is going to exacerbate the problem with price, because if you don't have supply, you're going to do a lot better on price in the future because demand isn't going anywhere. China is going to continue to grow at 7-8%. I did forget to mention that, but one of the things people forget, they talk about China slowing. China's economy has quadrupled since the beginning of, since 2000, say. 15% growth in 2000 is only half as much demand for commodities as 8% growth today. You can do the figures, but you're dealing with a much bigger base. China is a much more significant economy to the world today. 8% growth in China today is going to drive a larger commodity demand than was driven in the early 2000s, which started this cycle. So you've got cost and price, you've got capital projects decelerating, and you've got M&A starting to have a larger and larger impact. Those four trends, I would say, we see as broadly continuing throughout the year. The next five trends, the ones that are on the minds of mining executives of companies of all sizes, are really why supply of commodities is so tough. They're all about the hard things you have to do in mining. Things like resource nationalization. Now, it's not many places where mines are getting taken away from mining companies, but there are a lot of places where huge tax increases, royalties are being imposed. The need for governments to have a greater share of the economic pie. You know, as many of you know, governments in North America are short of cash. Well, governments everywhere are short of cash. And, there was a famous bank robber who once said, when asked why he robbed banks, he said, well, that's where the cash is. It's a bit like that with governments. You need tax dollars. Where the heck are you going to go? Well, you're going to go where there is some money. And that happens to be in mining. That is going to have a huge detrimental effect for future mines. Because the mines that are in production will stay in production. They can withstand extra royalties, extra taxes, et cetera. Could you just pour me a glass, please? Thanks. They're going to stay in production no matter what. But it's the new mines. And it's not the world-class deposits. The world-class deposits, they get built regardless because they're so rich. They can actually withstand confiscatory tax regimes. But it's those marginal projects. And if you get those marginal projects built, they will stay in production for many, many years. So in BC, British Columbia, we got a series of marginal projects. Some of them are quite good marginal projects, and some of my friends run them, so I shouldn't be dismissive of them. But those marginal projects, if we can get them into production, they'll form a huge amount of economic activity in this province for many years to come. That is important. You see that around the world. So resource nationalization is a problem. Corruption. Corruption is a bigger problem in a number of countries than it is in others, although in Canada, we can't stand very high on the pulpit with all of the activities in Montreal, for example, in the construction industry. Talk about looking bad in the eyes of the world. Like, that is just disgraceful. But it happens here as well. I don't think it's as widespread as in some locations, but it's here. Corruption is a tax on everybody, and particularly hard for mining companies. The best mining companies do not get involved in that because once you start, it is a never-ending street. You've got the whole social license issues, corporate sustainability. Let's face it, often people don't like miners because they don't like what mines do. Not everybody's like me. I love a beautiful tailings dam or a nicely symmetrical pit that's been dug in the earth, but it's not everybody's cup of tea. And we've done a bad job of engaging to explain the trade-offs. Yes, everybody would prefer pristine, never disturbed landscapes. However, we decided we want to live in cities. We want to build roads. We want to actually live in a nice lifestyle. You can't do that without having things like mines. If it isn't growing, it was mined. And that's the only two things that we use. So you kind of need it. But you have to explain that. We have to be more proactive. We have to explain the economic benefits. Mining is an incredible economic benefit to Canada, to the U.S. as well. The talent gap is there. I talked about the 20 years nobody joined the industry. If you read about it, it's not just sort of the senior levels. It's the immediate line supervisors that are inexperienced. I was giving a speech at a well-known university back east, and it was to an MBA class. And I was explaining that one of my clients, I won't use the name, it was building in Africa a mine. It went from about, I think started out at 1.8, went to 2, finally ended up at about $6 billion, billion with a B. And I said, one of the problems that I had seen through this was they didn't have the experience of people out on the site. And one of the guys in the back row put up his hand and he said, I worked on that deposit. And I said, oh, how old are you? He said, I'm 29. He said, I was running the mining engineering group. I had 400 people reporting to me. I graduated 5 years ago as a mining engineer, and I went out. Great experience. You know what? He is an incredibly valuable person because he has made every mistake in the book in real time, and, the mine's working now. However, the cost, just think of the costs. I was talking to somebody in Newfoundland. They're building a refinery there. They're expecting productivity of 20 to 25% of their skilled trades. I said, 20 to 25%? That means you need 4 people to do the job in the feasibility study that you planned. And he said, yeah. He said, that's a bit of a problem. He said, we do need 4 people, and it's ending up with a lot of overruns, cost overruns. But what did he attribute it to? He actually attributed it to the frontline supervision, not utilizing people, not kind of thinking ahead so that they had enough jobs lined up to keep people busy all the time. So they're paying a lot of people to kind of sit around, probably go to Tim Hortons, not Starbucks in St. John's, Tim Hortons. But those are the sort of things, they're the hidden killers. On this project in Africa, they got a big pipeline. And, I'm an accountant by background, but, you got to tighten up the screws to hold the thing together. Turned out the guys there really cranked those screws, ended up fracturing the steel over a very short time. They had to replace most of the pipeline. Think of the extra costs there. Nobody actually on the site realized that you can over-tighten screws in that. I've done it because I've destroyed things at home. I knew that, but the guys on site didn't. So those are the sort of stories that we're hearing. The next one is safety. Safety has come up as a bigger issue this year than it has in the last 5 years. There have been some very unfortunate fatalities at mines where fatalities are not expected to happen. Most big mining companies, the senior executives get 0 bonus if there is a fatality. And that's a big deal to them. It affects them personally. They are safety conscious all the time. There's been some problems, perhaps a lack of focus, perhaps inexperienced workers, but they're responsible. So those 5 things are reasons that I actually don't think we're going to see this massive rush into the mining industry. Rush of commodities, a rush of product in to satisfy this supply, the demand that I see created out of China. So the 5, just to recap, resource nationalization, corruption, getting permits, the whole corporate sustainability piece, the talent piece, and the safety piece. Those are all why mining is such a really, really tough industry and why it's going to be hard to see a lot of new mines filling the demand piece of the industry. If I go to the last trend, it's all about the future. One of the interesting things about mining is when you visit a mine today, it actually isn't that different than when the Egyptians did mining. You've got people there breaking up the rock. They're then transporting it. And, yes, they're doing it with bigger equipment and in more scale. But there's a lot of things that haven't changed. And we're seeing some technology coming now that actually could have a revolutionary impact on mining. A simple one, think of blimps. Everybody knows the blimp, the Goodyear blimp at the football games or something like that. But anyway, those are now in a place where, they could start to have a significant impact on supplying mines in northern Canada, but also on mines, shifting rock or ore from the bottom of a pit out of a pit. You're starting to see some of those elevators. Rather than have trucks driving around an open pit mine, having an elevator for the rock to lift out. We've now got flexible conveyor systems that work incredibly effectively. Flexible meaning they can go around corners and things like that, that old conveyors were very difficult to do. Those are the sort of things that you're going to see mining companies move ahead with. Technology, mining companies have been very, very slow to adopt new information technology. Most mines are built with a computer system. That computer system stays there forever. Well, in today's world, you actually need much more data than you get from that. So those are the 10 trends. You got the 2 mega trends, cost and price. You got the capital projects, mergers, acquisitions. They're really falling out of those first 2. You got the 5 reasons that you got a lot of problems in mining that make it a tough business. And then the future, what's going to happen? So if I was to summarize, I'd say I'm bullish about the mining industry. I'm bullish about the commodity prices. I'm actually even bullish about the exploration equity market. I think it's going to come back. I think it's going to come back faster than anybody anticipates. And if it does come back, or when it comes back, you're going to see a lot more excitement from the companies here. So with that, thank you very much. We do have a booth out there. You can pick up a copy of Tracking the Trends if you're interested. And thank you very much for your attention.